Hello, folks. Bill and Brian here with Energy Rogue with your weekly update. Hey, listen, we're going to make some predictions today, so you need to be paying attention. We might just happen to be pretty close, positively, could even be right.
What are you trained to
So,
do?
yeah, exactly. What are we trying to do? Well, let me tell you something, folks. One thing that Brian and I do is we do a lot of stuff together, and
we're two dudes setting out with a common goal.
that's us right there.
So, what we're going to talk about today is we're going to talk about peak oil, but in a different type of lens. You've heard Hubert's peak, you've heard, or if you haven't, it's a great geologic theory, and it dates back to, I believe he was with Shell. Was that where he was?
I think he was with Shell. He's talking. I think he was back. This is talking back in the 70s.
Yeah, yeah,
Yeah.
yeah. And when you get into production of oil and gas, it is a declining resource, which means every day that you don't do something mechanically to enhance the volume will decline over time. And in the shale era, the US has grown so significantly on the volume side. However, it's contrasted with a very high decline rate. So what we're going to talk about is 2026. Right now, there is a lens of we don't have enough demand. Is crude oil going to decline in demand over the next 10 years? We have plenty of supply. OPEC is restricting. So there's a bearish sentiment out in the marketplace, but we wanted to take a different lens and say why 2026 could look significantly different, and depletion is colliding with insufficient investment. So that is actually what is happening behind the scenes, and we're going to walk through that. So
And to talk about this a little bit better, when you talk about peak oil, there's the ability to produce, there's the market ability to absorb, and then there's the capital structures ability to actually even support that growth. So when you start talking about peak oil, it's not just one of those things. It's
mm-hmm,
how they all three. It's all how they all three work together.
mm-hmm.
And so and like we said, it's just math. Everybody has a calculator. It doesn't take a lot, but you do
Right,
have to use it.
right. And dating back to Hubert's peak and dating back to times before the U.S. Was able to enhance volume based upon the shale revolution, which was really a combination of hydraulic fracturing and horizontal drilling. That was
Right.
really the two factors that drove the U.S. to figure it out.
So
And
I look at that as a chemical advancement and a mechanical advancement.
Mhm.
The horizontal drilling was mechanical advancement. The fracturing was a chemical advancement.
Yep.
Those have not stopped continuing to grow, but they were the big two breakthroughs. So what's the next breakthrough? I personally think it's going to be chemical, but we'll see.
Yeah, we'll see. So the math doesn't lie. The exhaustion of cheap barrels in the United States, since the United States has been one of the largest contributors to supply growth over the last 10 years, over the last 15 years, really. And when we look globally, the U.S. has transformed from producing anywhere from 7 to 8 million barrels a day, um, upwards of 14. So we're just
Right.
shy of 14 million barrels a day. So that's significant. However, with the United States, the economics is really is central here. And when you have the capitalist motivation in the United States, the best wells with the best returns, with the most volume, with the most economic returns get drilled first. What that means is the next well is going to not perform as high on a volume or economic scale, which
Right.
means it's going to be harder for incremental growth without economic enhancement. And the easy geology is gone. And some of these break evens, when the Permian was just starting, $20 a barrel was all they needed. Now it's requiring 60. Break even costs, non-OPEC break even has doubled since 2010. And CapEx has been continuing to drop, especially since 2026,
And on, on
2016.
those on those break even prices, folks, it's not just what it takes. There's cost too. And the more regulations we put on it, the higher that cost goes, and that also affects the break even price.
Mm-hmm. Mm-hmm. So the canary in the coal mine,
By the way,
U.S.
Brian, you know how long we've been fighting this problem? Do you have any idea how long we've been fighting this problem?
Forever.
So, do you know when the first product was first product was what year?
It cut out a little bit. You might need your mic closer. Um,
So, the first year that we moved petroleum products on rail
mm-hmm.
was 10 years after the Civil War, 1875.
I knew it'd been a while. I knew it'd been a while.
So, we think the 70s, the 1970s was a long time ago, but 100 years before that, we were still facing these same three questions. So this is not something that's new. It just comes in with new nuances every time we look at it. So
Yeah.
that's why. So we've been producing crude oil in this country for 150 years, and now we're talking about how it's going to decline. Let's talk a bit more about how what it means to decline, and most of that has, I think, has to do with market more than just actual availability of the crude.
Yeah.
But the problem is the harder we hit the reserves when we hit them, the faster they decline.
Yep. Yep. And when you look at how it's been deployed, that's really where we are. But let's take a quick look. So the U.S. is currently producing about 13.8 million barrels a day. Every month, if we don't add new wells to the mix, Bill, how much decline is there on an average month if we
On an
don't do
average month,
anything?
we're losing 650,000 barrels a day.
650,000. Okay, so when you think about that, that sounds okay, but let's take that times 10. What that means is 6.5 million barrels a day would disappear inside of a year without new
Right.
production. So every month we are bringing on new production that is then contrasted or counterbalanced with decline. And so when you look at that, that's 650,000 barrels a day that needs to be replaced every month. And we actually track this on Energy Rogue, and there is a 14-day free trial down below. We'll get to that a little bit later, but this is the crude oil production change holistically for the United States, and we are actually below 20,000 barrels a day. So that means out of 13.8 million barrels a day of production, we are each month adding 0.02. So, hey, we're at 13.8. Well, that's because of 10 months of adding
Right.
0.02 to the equation. So that's when we actually track and monitor every single day or every single month. There's not daily data that is available unless you've got 100 grand a month that and a full team of 20 analysts. But this is how much new production we are creating, which that looks awfully close to 650,000, doesn't it?
Right. We're barely hanging on.
And here's the decline. There it is. And we actually track each individual basin so you can see. And what you'll see is a large portion of that is in the Permian, 427,000 barrels a day of declining production and 430,000 of new production. So we actually are looking at this trend, and what this is telling us is that we are declining, and Permian has hit a wall. And now let's talk about OPEC, spare capacity versus sustainable
As we
capacity.
all know that we can rely on OPEC to save us when the oil goes bad.
Well, so when you look at OPEC and the supply cuts and the actuals, there's a difference in how much they can produce and how much is spare capacity and how much they have produced in the past. Those are three different numbers.
Right.
Okay. A lot of people quantify spare capacity, but is that real? What we typically look at is what has been produced in the past gives us an indication
Of what they
on
would be able to produce in the future.
right,
And part of that is that when we look at this, there is this, and you have to think this is a process. There's not a spigot out there we go and turn on and the oil flows.
right.
There's a process involved, no matter what country it's in, and different countries it takes longer to get that quote spigot unquote turned on.
Yep, yep. And when we look at price history and whatnot, I want to note a couple things. 2022, we had incredibly high oil prices, right? Because of Russia, Ukraine.
Right.
The most that OPEC was pumping in 2022, 2023 was 36. We have gotten to close to 37. Last time we touched that was in 2018, 2019. So realistically, there's not much more that OPEC can really do when it comes to spare capacity and sustainable capacity. So what we're looking at is a cliff. There is still constrained volume from UAE and Saudi Arabia. Those two countries do have some capacity that they can add some barrels. But how much? Is it a million? I don't know. And then you counterbalance that with another factor, which is the United States has not grown in production significantly at $60, at $70, and even at $80. At $80, we started making a little bit of production adds. And yes, we're at 13.8. And yes, it is a new record. But what were we a year ago? Well, let's take a look at that. And this is actually inside of Rogue Radar, um, which gives you this every single day with our thoughts on the market, OPEC analysis, and market summary that includes technical analysis. But take a look at this. So right now, we're at 13.8 million barrels a day. Our 3-year average was 12.8. But where were we last year? 13.4. That's not significant growth. That is 400,000 accumulated over 12 months. So we are going to need higher prices to actually see a higher output in the Americas. That includes the United States, that includes Brazil, that includes Guyana, that includes Venezuela, which I don't know what's happening there. So we'll have to see. But when we're connecting the dots, you have natural declines, we have demand growth. The one counterbalance is China is filling their strategic petroleum reserve. Are they going to stop at some point? When they do, that means that we're going to have a little less demand, and that's because of economics. That's not because of lack of
Yeah.
growth.
It gets
That
up to
that's
about 75 or 80. They're pulling out of their strategic worth. They won't stop buying because they still won't have enough.
Right.
They just won't be buying as much.
Right. And
And when we talk about
2026,
price on this, we have to realize when we talk about price, we have to realize that we're not saying, oh, it got to 80 for 2 months in 2026, so the world's better. No, we need a sustained price increase for up to 3 years in order for these projects to be able to hedge and pay out.
and when we
So,
look at this is our forward curve right now.
yeah,
What's the max price here? 62. It's not going to do it. So
yeah,
if OPEC, UAE is going to be able to add some, but what is that, like 500,000 barrels? Something like that?
up to 1 million barrels, but yeah, but that's
Up
a
to
three-year process.
up to 1 million barrels. Well, at $60, the US is not going to be adding any. And if
No,
we actually have demand growth, which India is growing like crazy,
right.
the price
Well,
and
bottom line is
heat,
the U.S. demand's still growing.
yeah. And so what we're doing is we're burying the lead, which is if you don't have adequate price, volume will decline and we will not have enough. So what can you
Now, what
do
also
about
means
this?
that volatility is going to increase as well.
Yeah. What can you do about this? If energy markets impacts you or your business or trade, if you're trading, if you're hedging, if you're buying, if you're selling crude oil, natural gas liquids, refined products, you have to arm yourself with information to understand what the forward market is going to do. And your options are really threefold. One, you can spend 30 hours a week or hire a team to do that. And we know because we've done that.
Right.
Two, you can spend $50,000 a month and get all the toys in Bloomberg, Reuters, Wood Mackenzie, pick them.
Yeah, and still have to evaluate.
Yeah, S&P, Platts, Argus, all of those, and we know because we've done that. We created a third option, which is Rogue Radar, which is $89 a month. There's a 14-day free trial in the link below, and it compresses 30 hours of research into a 5-minute read to where you can read through this every single day and basically have a dashboard of where the market is. You've got OPEC analysis, you've got CFTC reports, the news analysis. If you don't have time to read 30 to 100 articles a day, we have AI that actually does that. We actually project using machine learning what the forward prices may hold, along with our expert industry veteran approach to where the market may go. Every day we put this out that gives us an idea of where the future may take us. So the answer is clear. You can ignore the markets. If energy impacts your business, you can ignore the markets and just hope for the best. Hope is not a strategy. And every time that you approach the market, and you ask it for higher prices if you're a producer or lower prices if you're a consumer, every time you're faced with
Hey,
that.
I see your rental agreement.
Exactly.
And if you have more than 3 spreadsheets trying to figure out markets,
Do
this
you feel this vehicle is safe for highway travel?
that's what you end up with. And we know because we've done it.
Right.
And that's why we
And
created Energy Rogue.
so, folks, the problem is you need to understand the energy markets. Solution is Energy Rogue. It's really just that simple.
Yeah.
We try not to make it hard, and if you do that, then you would be able to accomplish some of the goals you like. Similar to this.
However, if you impound our car, I'm gonna be unable to get my friend here home in time for his Thanksgiving dinner.
That's it. So you can subscribe today
Yeah.
before Thanksgiving, and you can get your friend home for Thanksgiving.
Absolutely. And listen, closing off, what you see is what you get.
What you see is what you get.
There
That's
you
right.
go. Said it's best. So, two movie recommendations because it is Thanksgiving week: Freebirds and Planes, Trains, Automobiles, which we featured today. And the main thing that we want to take away from this is to
be excellent to each other.
Absolutely.
So that's all we got this week. So it's about 20 minutes. So appreciate you stopping in. And
Appreciate you giving us your time.
if you want to understand a little bit deeper of this, you actually can sign up for the 14-day free trial. We have an onboarding call with everybody that joins. So in that onboarding call, we can talk about this thesis that we have around peak oil, because it is truly happening. And it's not because we're running out of resource. It's the economic viability. That's the key. The math just doesn't work. So that's what we got. So I hope you have a fantastic Thanksgiving. And any closing thoughts, Bill?
Listen, you guys, go enjoy one another. Don't cause trouble. Just be nice to your family. Eat some turkey. Go home. And I know Black Friday is a completely different thing than it's ever been before. So get on your computer, and I think we ought to call it like Electron Friday or something. But hey, enjoy your holiday, and let's hit it back next week, and let's make some money.
Yeah. So listen, folks, thanks so much. Thanks for hanging with us, and hope you have a fantastic week, and we will see you next week.